All right, welcome to another session of the My Solo 401k Financial My Community YouTube webinar series. We're about to get started. If you have questions or topics you want to discuss, please feel free to chat those over as we should have time at the end to go through some Q&A. But we did bring some slides we're going to start out with. Today is a great topic. It's a very popular topic. You could think of it as the Solo 401k magic number, as we're going to go over how much income I need in order to be able to maximize solo 401k contributions, specifically focused on businesses that are taxed as an S-Corp or a C-Corp. It could be an LLC taxed as an S-Corp or a C-Corp. So thank you so much for joining. Please like and subscribe if you're on YouTube so you can get notifications of these sessions going forward. So the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So again, if you like and subscribe, that would be fantastic. We do have a series of webinars, coming up focused on this topic. So we're going to talk about sole proprietorships, partnerships in future sessions, as well as lots of other good content on the docket here. So if you subscribe, you'll get notifications of all the webinars. You can come back later and watch a recording, etc. So again, this topic is, a common question. How much self-employment income do I need in order to be able to maximize my solo 401k contributions? So we're going to go through some resources, talk about, of course, the basics like eligibility, go through the contribution rules. We're going to go through a number of different scenarios to really illustrate how those rules work and answer that question of how much income do I need to make. And then we've got some bonus content, which is a popular topic as far as the solo 401k tax credit. So as far as resources, we go live every day at 1 p.m. Pacific, 4 p.m. Eastern on our community. Of course, we're here today on the YouTube channel, but on the community, it's always free to join. All are welcome. You can find us at mysolo401k.net/my community. You can post questions in the forums. We have a library of hundreds of videos and webinars. So there's tons of great content, tons of ways to learn and to share the knowledge. So as far as the basics, right? Who's eligible to set up a solo 401k? Well, you have to be self-employed, right? A 401k is for an employer. A solo 401k is for an owner-only business with no full-time W-2 employees. So you don't need to have a formal legal entity for your business. We have many, many clients who operate as sole proprietors, but you do need to report earned self-employment income on your taxes, right? That could be Schedule C in the case of a business taxed as an S-Corp, W-2 wages for a business that's taxed as an, Schedule C for a business that's taxed as a sole proprietorship, W-2 wages for a business that is taxed as an S-Corp or a C-Corp, could be an LLC taxed as an S-Corp or a C-Corp. There's no minimum amount of earning income that you need to report in order to be eligible to set up a plan. But if your goal is to make contributions, right, you can't save more than you earn. So you're not going to be able to save more than your W-2 wages. So you don't necessarily have to have a minimum amount of earned self-employment income to be eligible. But if you don't receive or report a significant amount of earned self-employment income, in other words, W-2 wages, right, for a business that's taxed as an S-Corp or a C-Corp, you're not going to be able to save more than those W-2 wages. Now, your spouse or business partner could also participate in the plan as long as your spouse or business partner is receiving their own earned self-employment income, right, like their own W-2 from the self-employed business. You can have a solo 401k even if you have a day job, even if you participate in your day job employer-sponsored 401k plan. So as long as you've got that separate self-employment activity, you've got that separate earned self-employment income, you could set up a solo 401k and then make contributions to the solo 401k based on that separate self-employment income. And we'll talk about that when we get to the slides going over the scenarios. So as far as the top solo 401k benefits, of course, contributions, the solo 401k has the highest contribution limits for any defined contribution plan available to self-employed individuals. And for 2024, you're going to be able to contribute, if you have the self-employment income to justify it, up to $69,000 or even $76,500 if you're 50 or older. With our plan, you can make those contributions as pre-tax contributions to reduce your taxable income, and or you could make those contributions as Roth or mega bracket or Roth, where you're not going to be able to reduce the taxable income for the year for which the contribution is made, but you've got the potential for tax-free growth like any Roth retirement account. And then on top of that, other top use cases would be alternative investments like real estate, crypto, notes, as well as the ability to take a 401k participant loan, where you're able to literally take the money out of your 401k account. It's not considered to be a taxable distribution as long as it's properly documented as a loan, and we handle the loan documentation requirements as part of our service for no additional charge. So focusing on the contribution features, right, as far as the use case, and focusing on how much income I can contribute to the plan, how much income I need in order to maximize my contributions, right? We always want to start out with, okay, well, when you're determining how much you can contribute, it's good to recognize that your ability to contribute depends on different factors. Now, one, of course, is the income, right? Because you can't save more than you earn. And we're going to talk about exactly how much income you would need in order to be able to maximize contributions. But other factors are going to be your age, because once you're 50 or older, the rules allow you to make what they call catch-up contributions. For 2024, that catch-up contribution limit is $7,500. An additional factor would be, do you participate in another retirement plan, right? So we established that you can still have a solo 401k even if you do participate in a day job plan, but your ability to contribute to the plan in terms of making employee contributions is impacted if you're also making employee contributions to a day job plan, because that employee contribution limit applies at the employee level. So you have to aggregate across all plans in which the solo 401k owner makes contributions. And then lastly would be the type of contribution, right? Whether it's employee versus employer, because the contribution limits are different, or whether it's pre-tax, Roth, or after tax. So that kind of sets the foundation as far as understanding that there are different factors that go into play in terms of how much you're able to contribute. So the first factor we talked about is, right, it's your self-employment income, right? The whole purpose of a 401k is it allows someone who works to save for retirement. The whole purpose of a solo 401k is it allows a self-employed individual to save for retirement. But you still have that notion of earned income, right? This is not for someone who has investment income to save for retirement. It's for someone who has earned worker type income to save for retirement. And so what earned income is for a business that is taxed as an S-Corp or a C-Corp, could be an LLC taxed as an S-Corp or a C-Corp, is the W-2 wages that individual receives from their self-employed business. So it's got to be the W-2 wages from the self-employed business. In other words, you cannot use W-2 wages from other sources like a day job to justify contributions to the solo 401k. You're also not going to be able to use income that you receive as the owner of the business, like a K1 from an S-Corp, to justify solo 401k contributions. Because again, it's supposed to be based on the earned income, not necessarily the investment income. So again, based on W-2 wages, not passive income. So that should say wages, not pages. Let's get that cleaned up real quick. So thank you so much. So again, the W-2 wages, not passive income. So in terms of what are your W-2 wages specifically, well, you would start with box one of the W-2 and then add back any elective deferrals, pre-tax elective deferrals, not in box one, but instead over in box 12, right? Let's say you receive $100,000 of W-2 wages from your self-employed business. Let's assume that you contribute $20,000 as a pre-tax employee contribution to the solo 401k. So your box one of your W-2 is going to be reduced by that $20,000 because that was a pre-tax contribution. So box one of the W-2 is going to show $80,000 And then box 12 is going to show that $20,000 pre-tax elective deferral. So when you're determining how much you can contribute to the plan, you take box one, 80,000, plus any pre-tax elective deferrals not in box one, but instead over in box 12, you add them together. So really, it would be $100,000 of self-employment compensation in that scenario. So another factor, of course, is the overall limit. Now, for 2023, the overall limit is $66,000 plus another $7,500 for that catch-up contribution if you're 50 or older. The limit was raised to $69,000 for 2024. The catch-up contribution stayed the same, $7,500. So if you're 50 or older in 2024, you have the potential to contribute up to $76,500. That's how we get to the $76,500 figure. So it's good to also understand, right, that there are different types of contributions, right? Remember I mentioned that the solo 401k has the highest contribution limits for any defined contribution plan available to self-employed individuals. And that's because when you're self-employed, right, in the words of the IRS, you're both the employee and the employer. You're able to make both types of contributions, which is how you're able to contribute such a relatively high amount. That's why it has the highest contribution limits, because you can make both the employee and the employer. So in terms of the employee contributions, those can be made as pre-tax to reduce your taxable income. If, in addition, if you have a plan like ours that allows it, those can be made as Roth. Now, there also is a third type of employee contribution that can be made, which is voluntary after tax. Our plan allows for that. That's how someone is able to contribute. That's how someone is able to make a mega backdoor Roth contribution. The voluntary after-tax contribution limit is actually higher. We're going to talk about the after-tax limit. It's higher than the pre-tax and Roth employee limit because it comes from a different section of the code. Because it comes from a different section of the code, pre-tax and Roth employee contributions are impacted by contributions made to another plan, like a day job plan. So your ability to make pre-tax and Roth employee contributions, right, that limit applies across all the retirement plans that the individual is making contributions to. Whereas the after-tax contribution limit pertains just to the plan itself, right, just to the solo 401k. So it's not impacted by contributions made to a day job plan. Continuing on, employer contributions historically were always made as pre-tax contributions. With the Secure Act 2.0 that was enacted at the end of 2022, now those employer contributions can be made as Roth contributions. And we'll talk about why for our client base, it's really not utilized, but technically that is an option. Unlike the pre-tax and Roth employee contributions, which are your ability to make those types of contributions to the solo 401k is reduced by contributions made to a daytime job 401k plan, the employer contribution limit applies at the employer level, doesn't apply at the employee level. So even though that solo 401k owner might have maxed out contributions that they made to a day job plan, that won't reduce their ability to make employer contributions to the solo 401k because that employer limit applies at the employer level. So in addition to employee versus employer, you've also got the different types such as pre-tax, Roth, or after-tax. Now, Roth historically was always just an employee contribution, right? So that means it would include the catch-up contribution, the $7,500 catch-up contribution. Now with Secure Act 2.0, technically it can be made, an employer contribution can be made as a Roth contribution. We'll talk about the mechanics and why that's not really utilized so much with our client base because they've always had the ability to make the other type, which is after-tax contributions. So after-tax contributions are technically an employee contribution, but the limit is different. It's higher than the pre-tax and Roth employee contribution limit. Catch-up contributions, those are not made as after-tax contributions. They would have to be made as either pre-tax or Roth employee contributions. And then after-tax contributions are not impacted by contributions made to a day job plan. So hopefully this is a good slide to introduce these topics. We're going to go through it a little bit more in detail, just to review and emphasize the different points. So now let's go through each subtype, right? So you have pre-tax employee contributions. These are also referred to as salary deferrals. So the limit is 100% of the self-employment compensation. Remember, for a business that's taxed as an S-Corp or a C-Corp, that's the W-2 wages that are received from the self-employed business. So the solo 401k owner is able to contribute 100% of those W-2 wages, dollar for dollar. Now, for 2023, that's up to $22,500 plus an additional $7,500. For 2024, that was raised up to $23,000 or $30,500 if you're 50 or older. Now, again, this employee limit applies at the employee level. So the solo 401k owner would need to reduce how much they can contribute as an employee contribution to the solo 401k by any contributions made to another employer plan, like a day job 401k plan, unless the other plan is a 457 governmental plan. So these employee contributions, these salary deferrals, they can be made as either pre-tax or Roth, could be a mixture, but the total amount can't exceed that limit, right? For 2024, 100% of the wages up to $23,000 or $30,500 if you're 50 or older. If you're going to make Roth employee contributions, they need to be deposited into a separate sub account. For our clients, we're helping clients open up all the requisite number of sub accounts at the bank or brokerage of choice. So for example, let's say they want to have the accounts at Fidelity or Schwab, right? They'd have one brokerage account at Fidelity for pre-tax, a second for Roth, and then if they're making after-tax contributions, a third after-tax account. So also note that the catch-up contributions would go into this category. So those catch-up contributions, the $7,500, it's a type of salary deferral. It's either pre-tax or Roth. So now let's move on to the other main type, which is employer contributions. Employer contributions are also referred to as profit-sharing contributions. Now, the employer limit, unlike the employee limit where it's 100% of the wages, the employer limit is a percentage. It's 25% of the wages. So then that becomes a question, well, 25% of what? And that's where we go back to what we talked about earlier, right? You take box one of the W-2 plus any pre-tax elective deferrals not in box one and instead reported in box 12. You have to keep in mind the overall limit, right? So all the contributions that are made to the solo 401k, whether it's employee, employer, and or after tax, can't exceed the overall limit. For 2023, that's $66,000 plus an additional $7,500 if you're 50 or older. For 2024, that's $69,000 plus an additional $7,500 if you're 50 or older. So unlike the employee, where that limit applies at the employee level, the employer contribution limit applies at the plan level. So it's not impacted by contributions made to another plan like the day job 401k plan. Now, one exception to that rule is the 403b exception. So if the individual is making contributions to a 403b, or if contributions are being made on behalf of the individual to a 403b, all of those 403b contributions, whether made by the individual or on their behalf, like an employer contribution, together with any contributions that they want to make to the solo 401k, can't exceed the overall limit. Now that brings us to the new ability to make employer contributions as Roth contributions. This was allowed under Secure Act 2.0. So I mentioned for our plans, right, for a solo 401k plan that allows for mega backdoor Roth contributions, in other words, after-tax contributions, many choose to simply make those after-tax contributions and decline to make employer contributions as Roth contributions. Why would that be? Well, the voluntary after-tax contribution limit contributions could be made at a higher percentage, right? Remember, we just talked about the employer contribution limit is 25% of the W-2 wages, whereas the after-tax limit is 100% of the W-2 wages. So someone's going to be able to more quickly reach their contribution goals with a smaller amount of W-2 wages, because they're going to be able to contribute 100% of those W-2 wages dollar for dollar. From a deadline perspective, they're equal, right? The deadline to establish a solo 401k in order to make both employer and after-tax contributions is the same, right? The plan just needs to be established in time to make the contributions by the business tax return deadline, including any timely filed extension. So that means if someone didn't set up a plan, hasn't set up a plan yet, right? But they filed an extension for their 2024 business tax return, right? Let's say they are an S-Corp and they filed an extension for their 1120S, or they're a C-Corp and they filed an extension for their 1120. They could still set up a plan and make 2023 employer and or after-tax contributions by the business tax return deadline, including any timely filed extension. So from a deadline perspective, employer as well as after-tax contributions, it's the same deadline. Third point would be that there's more flexibility with respect to those voluntary after-tax contributions. So for example, voluntary after-tax contributions may be transferred to a Roth IRA without having to meet a triggering event. Whereas if someone makes employer contributions as Roth contributions, they would have to meet a triggering event before they could transfer those funds out of the solo 401k to a Roth IRA. So for some individuals, their goal is to make the voluntary after-tax contributions and then transfer them out of the plan to a Roth IRA. And there's no triggering event that has to be met. They can do that if the solo 401k plan allows it, like ours does. So that would be the third reason why folks, in our experience, would just go ahead and make after-tax solo 401k contributions and decline to make employer contributions as Roth contributions. But if someone does make employer contributions as Roth contributions, some of the frequently asked questions are, okay, well, do I need to deposit those employer contributions made as Roth contributions in a separate account? Well, they definitely need to go into a separate Roth account versus pre-tax or after-tax, but it could be the same Roth account that the individual is already making Roth employee contributions to. Second would be, what is the contribution limit? Well, it's the same limit that applies to employer contributions generally, right? It's 25% of the self-employment compensation. In other words, the W-2 wages from the self-employed business taxed as an S-Corp or a C-Corp. How do I report employer contributions made as Roth contributions? Well, this was an open question for almost a year after the Secure Act first authorized employer contributions to be able to be made as Roth contributions. Almost a year later, the IRS came back with their guidance, which is in IRS Notice 2024-2, where they confirmed that employer contributions made as Roth contributions are actually going to be reported as tax deductible, like a pre-tax contribution on the employer's return for the year for which the contributions are made, and then reported as taxable to the employee for the year for which the contributions are deposited via Form 1099-R. So remember how we talked about how you could still set up a plan if an extension was filed for the business tax return up until the extended tax return deadline. You could still set up a plan and make employer contributions, for example, for 2023. So in that scenario, those contributions are being made for 2023, but they're being deposited in 2024. So per IRS Notice 2024-2, those employer Roth contributions for 2023 would reduce the taxable income on the employer's return for 2023, but then raise the income. It would be taxable to the employee, so it would raise the employee's taxable income for 2024. So from a reporting perspective, it's really no different than as if the individual had first made a pre-tax employer contribution and then immediately moved the funds as an in-plan conversion from the pre-tax account over to the Roth solo 401k account. Now, you don't literally have to go through those two-step process of putting it into the pre-tax and moving it to the Roth, but from a reporting perspective, they're indistinguishable. Okay, so that brings us to the voluntary after-tax solo 401k contribution limit. So as mentioned, right, you can contribute 100% of the self-employment compensation, the W-2 wages from the self-employed business taxed as an S-Corp or a C-Corp, dollar for dollar up to the overall limit, right? So up to $66,000 for 2023, $69,000 for 2024. Now you have to keep in mind the overall limit. So the sum of any other contributions made to the solo 401k, whether employee or employer, along with the after-tax contributions that you want to make, can't exceed the overall limit. But when you're running that calculation, you don't have to factor in the catch-up contributions. So remember I said that catch-up contributions are not made as after-tax contributions. They're either made as pre-tax employee or Roth employee. So, but at the same time, when you're determining how much you can contribute as an after-tax, you don't have to reduce that amount by any catch-up contributions made to the solo 401k. So effectively, you can still get to the same place, right? For 2024, if you made $7,500 as a catch-up employee Roth contribution, and then you make another $69,000 as an after-tax solo 401k contribution, you're still getting to $76,500 in total contributions to the solo 401k. So unlike the employee, the after-tax contribution limit applies at the plan level. Therefore, it's not impacted by contributions made to another retirement plan, like a day job 401k plan, unless the other plan is a 403b. Then you get that 403b exception, where you aggregate all the employee contributions made to the 403b, all the employer contributions made to the 403b, together with any contributions that you want to make to the solo 401k, and the sum of those contributions cannot exceed the overall limit. Lastly, just like Roth contributions, after-tax contributions need to be deposited into a separate sub-account. So this is how folks end up with 3 different sub-accounts: pre-tax, Roth, and after-tax, or 6, right? If there's, say, 2 spouses that are working in the same self-employed business and they're both making mega backdoor Roth solo 401k contributions, with each person having a pre-tax, Roth, and after-tax for a total of 6 accounts. So now let's get to the scenarios, and we can talk about those magic numbers, right? As far as how much income one would need in order to be able to maximize contributions. So I think it's noteworthy that there are different scenarios, right? Some folks have different objectives. So we're going to kind of go through the different profiles and answer the question for each profile. So in the first scenario, let's assume this individual does want to maximize their solo 401k contributions, but wants to keep their W-2 wages as low as possible. So again, today's session is really focused on businesses that are taxed as an S or a C. If you subscribe, we're going to go through other types of businesses, and you'll get notifications of those webinars, those future webinars that are geared more towards sole props and partnerships. But for today, let's assume the self-employed business is taxed as an S or a C. It's one participant who does not make contributions to another plan, like a day job plan. They want to contribute 100% of their wages from the self-employed business to the solo 401k, right? Because they want to keep those W-2 wages as low as possible. And they're only going to make the employee contributions, only make the salary deferrals, right? So in that scenario, if the person has at least $23,000 of W-2 wages from their self-employed business for 2024, or $30,500 if they're 50 or older in W-2 wages from their self-employed business, they're going to be able to contribute all of it to the solo 401k. They can make it all as an employee contribution. It could be pre-tax or Roth, right? Because this really highlights that the employee contribution limit is 100% of the wages, dollar for dollar, up to $23,000 for 2024, plus an additional $7,500 as a catch-up if they're 50 or older. So in this scenario, right, they would have put all their wages into the business. They can't save more than they earn. They're not going to be able to make any more pre-tax employer contributions, not going to be able to make any more after-tax contributions. So now let's go through a different scenario, right? So same concept. The individual, though, they're willing to raise their wages, but they're really looking to still contribute all the wages to the solo 401k. So they want to keep the wages low, but it's not as low as possible, right? So they would be open to making, say, employer contributions. So again, self-employed business, taxed as an S or a C, one person, doesn't make contributions to another plan, like a day job plan. They do want to contribute 100% of their wages from the self-employed business, but they're willing to make both employee and employer contributions. So in this scenario, if the person is under 50 and they have at least $30,666.67, they would be able to contribute 100% of those wages to the solo 401k, right? So they could contribute 23,000 as an employee, just like in the first scenario, and then they're going to be able to contribute 25% of their W-2 wages as an employer. So that would be $7,666.67. Now, if they're 50 or older, if they have $40,666.67, they'd be able to contribute $30,500 as an employee contribution. And then they could contribute the difference, $10,166.67 as an employer contribution. So now they're still contributing 100% of their wages, right, to the solo 401k. Okay, so now let's go to a different scenario when someone talks about maximizing their solo 401k. Let's assume this person wants to maximize the income tax reduction benefit for the year for which they're making the contribution. In other words, they want to maximize pre-tax contributions to the solo 401k, right? One person, business is taxed as an S or a C, doesn't make contributions to a day job plan. Goal again is to maximize the pre-tax solo 401k contributions to reduce taxable income. They're willing to fill up both the employee as well as the employer buckets. So if this person receives $184,000 in W-2 wages from their self-employed business, right, regardless of whether they are a 50 or older, they're going to be able to contribute $23,000 if they're under 50 as an employee, and then another $46,000, 25% of the W-2 wages as an employer. So at the end of the day, they would have contributed $69,000 as a pre-tax contribution to their solo 401k. Now, if they're 50 or older, they'd be able to contribute $76,500, an additional $7,500, which would go in as a pre-tax employee catch-up contribution. So that would reduce their taxable income by $76,500 if they're 50 or older. Okay, last scenario. Let's say this individual is not so much interested in making pre-tax contributions, but wants to maximize the Roth, the after-tax contributions. So again, let's assume they've got a self-employed business, taxed as an S or a C. One person doesn't make contributions to another plan like a day job plan. They're not going to make the employer Roth contributions because, as we talked about earlier, most of those clients are finding that they prefer to just make contributions as after-tax contributions. They're not really seeing a substantive benefit of making employer Roth contributions. So in that scenario, if the person is under 50, as long as they receive at least $69,000 in W-2 wages from their self-employed business, they're going to be able to contribute 100% dollar for dollar as an employee contribution up to $23,000. And then they could do another $46,000 as an after-tax contribution. It would need to go into a separate voluntary after-tax account before it gets moved over to the Roth account. So thank you so much for your patience. Just to be clear and avoid confusion. So again, just to be clear, this is a Roth scenario. So they're going to, again, put $23,000 as a Roth employee, and then the difference up to $69,000, so 100% of their wages as an after-tax now have been contributed to the plan, goes into a separate after-tax account before it gets moved over to the Roth. So at the end of the day, they have $69,000 in their Roth solo 401k sub-account. If they're 50 or older and they receive at least $76,500 in W-2 wages from their self-employed business, they could put $30,500 as a Roth employee contribution, and then the difference, another $46,000 up to $76,500 as an after-tax contribution that then gets moved over to their Roth solo 401k. So at the end of the day, they got $76,500 in their Roth solo 401k sub account. Okay, that takes us to the end of the section regarding the contributions. Let's just quickly touch on the $1,500 tax credit. So this is a credit that one of the credits that was authorized under the Secure Act. Some of the other credits are not available to a self-employed individual that sets up a solo 401k because it would require having a non-owner employee, such as the startup cost credit. But the automatic participation credit is available to a self-employed business, an owner-only business, as long as they set up a solo 401k plan that includes the automatic participation feature, like our plans do, right? Like new plans that we're setting up do. So it's going to be available to new plans, or you could convert an existing plan from, say, like a discount brokerage like Fidelity or Vanguard. The credit is actually structured as over a 3-year period. So it's $500 per year for 3 consecutive years. And it's not based on the actual cost to set up and maintain the plan. So even though our costs are less, the individual would still be eligible to claim the full $1,500 in credits. If you set up a new plan in 2024, the individual would be able to first start claiming the credit when they file their 2024 taxes, and then again for 2 more years. Or if you convert an existing plan, like say from the discount brokerage scenario to our plan, such that it now includes that automatic participation credit, that would make the self-employed individual eligible to start claiming the credit when they file their 2024 taxes next year. So it has a tremendous impact on the cost. So for example, our fees are $650, which includes the $525 establishment fee, plus the first $125 annual fee. So in the first year, your net cost is $150. And then in 12 months later, our annual fee would be due that would cover the second year. It's a $125 annual fee, but the individual would still be able to claim the full $500 tax credit. So in year 2 and 3, right, the value of the credit is much more than the cost, the $125 annual fee. It's a tax credit, not a tax deduction. So that means that you first determine your tax liability, and then you're able to reduce that liability dollar for dollar by the value of the credit. So in that way, tax credit is much more valuable or beneficial than a tax deduction. Again, you have to be eligible to set up a plan, then set up a plan like ours that includes the automatic contribution feature. What is the automatic contribution feature? Well, it sets a default 3% contribution percentage, but the solo 401k owner, as the employee participant, has to be given the option to opt out of the default 3% amount. And so by opting out of that default 3% amount, now the individual can contribute more, can contribute less, can contribute in whichever schedule or interval they prefer. In other words, you're not even required to make annual solo 401k contributions to qualify for the credit. Yes, if you have an existing solo 401k plan, you can certainly upgrade it to our plan to make the individual eligible to be able to claim the credit. The way that you claim the credit is by filing Form 8881. And we have a number of deep dive walkthroughs to really walk through the different scenarios, because that's the first step in the process to be able to claim the credit. The remaining steps are going to depend on how the business is taxed. So we walk all of our clients through that, and we share that content. We have a deep dive walkthrough video webinar that goes through how to claim the credit. So again, there's tremendous resources on our website, mysolo401k.net/my community. Thank you so much. As we went through these slides, we want to turn to the questions that are being chatted up. Thank you for bringing the good questions. 2 questions. What are the mechanics of adding an auto enrollment feature? Is it simply having it added to the plan document language? No, it's not as simple as that. I mean, it has to be elected in the plan documents, but there are additional notices, paperwork, election forms that need to be prepared and then completed. Of course, we prepare the full packet for all of our plans that include the automatic participation feature. Does the pro rata rule apply to 401k balances? Do we need to worry about it? Or can we simply maintain pre-tax contributions in one account and after-tax in another, and then convert at any time? So the pro rata rules do apply to 401k plans. but they apply quite differently than the way they apply to, for example, IRA accounts. So with a 401k, they apply at the account level. This is why it's so important to keep those after-tax funds in a separate after-tax account that would allow that individual to just transfer the after-tax funds to, say, a Roth IRA or Roth solo 401k, even if they do have other types of funds in other sub-accounts, like a pre-tax or Roth sub-account. Hopefully that helps. Thank you for bringing a good question. 52-year-old male, spouse is 47. What is the recommended amount of contribution for pre-tax Roth after tax for tax efficiency? W-2 income from S-Corp. So I would take a look at some of these scenarios, right? So if you're trying to maximize first the pre-tax, right? Let's go back to some of these scenarios. There's different, you could first, for example, fill up if you really want to maximize the pre-tax, that would be scenario number 3, right? Where if you have $184,000 of W-2 wages from a self-employed business for 2024, now you're going to be able to put the full $69,000 or $76,000 if you're 50 or older as pre-tax contributions. Now, some folks may not report that much W-2 wages. Let's say they had $100,000, right? They could still get a significant income tax reduction benefit, pre-tax benefit, because, for example, if they're not participating in another plan, such as a day job plan, let's assume they're under 50. Let's assume they have $100,000 of W-2 wages. They're going to still be able to put that $23,000 pre-tax employee contribution, 100% of the W-2 wages, up to $23,000. They could still put in 25% of the W-2 wages. Again, assuming it's $100,000, that'd be $25,000. So now they've got what? 23 plus 25, 48,000 as a pre-tax employee contribution. And then they'd be able to do the difference up to 69,000 for 2024, since they do have that $100,000 in W-2 wages. They could do the difference up to 69,000 as an after-tax contribution, and then move those after-tax funds over to their Roth solo 401k or Roth IRA. So it's kind of a hybrid approach. Hopefully that helps. Thank you for bringing a good scenario. So a daytime job 401k. So we have a lot of folks who might have a job in corporate America, and they have a 401k plan through their employer, but they also have a side business, right? A side hustle, right? So they may have a separate solo 401k plan for their self-employment income. And the fact that they have that day job, the fact that they even participate in their day job 401k plan is not going to preclude them from being able to set up a solo 401k based on their self-employment income. Am I able to invest in, thank you for bringing the good questions. Am I able to invest in short-term rentals via 401k finance business? So good question. Definitely that's a Rob's 401k as opposed to a solo 401k. So a Rob's 401k is used to fund an active business. An operating company is what they call it. And there's different ways to be an operating company. One is providing goods or services. Another would be what they call a real estate operating company, where the company owns real estate that it's managing or developing. So of course, the real estate would need to be owned by the C corporation that's funded with the ROBs. And then the C corporation would need to manage or develop that. All the income and expenses would flow in and out of the C corp, et cetera, et cetera. So within that framework, it would be possible to have that type of real estate operating company through the Rob C corp. Hopefully that helps. Thank you for participating. 48 years old, S-Corp, and I'm the only employee, would like to retire in 15 years, but have about 30,000 in savings. Yes, so that's a common scenario, right? I mean, that's one of the great things about the fact that a solo 401k has the highest contribution limits for any defined contribution plan, that's available to self-employed individuals, right, that might not have that kind of regular income as if they've been working for 20, 30 years in corporate America. So they're able to play catch up, because they're able to contribute, these relatively high amounts to a 401k. So thank you so much for the good participation. With a single member LLC, what is the deadline for a solo 401k contribution if I file an extension? Right. So it's going to be the business tax return deadline, including any timely filed extension. So for a business that is taxed as a sole proprietorship, right, it could be a disregarded entity like a single member LLC, where that income is reported on Schedule C of the 1040. The business tax return is really that 1040. So if a timely extension is filed for the 1040, that would give the individual until October 15th to make those solo 401k contributions. Now, if they don't already have a solo 401k plan, if they didn't set it up by the end of 2023, they could only make employer and after-tax contributions to the solo 401k for 2023. But going forward, right, or if they had set up a plan before the end of 2023 and they filed a timely extension, now they're going to be able to make all types of solo 401k contributions, whether employee, employer, or after tax, assuming they have a plan like ours that allows for those types of contributions, all the way up until the extended deadline, October 15th. Hopefully that helps. Will you do? Yes, absolutely. Please subscribe, as that's the next one on the docket. Now, if the self-employment income is being received and reported as W-2 wages, you would use these rules to determine how much can be contributed, right? You would use those W-2 rules, like the ones we've been going through today. How can I use my solo 401k Roth to invest in cryptocurrency? Well, you have to have a plan like ours that allows for investing in alternative investments, such as cryptocurrency. You have to open up an account at an exchange under the name and the EIN number of the plan. And if the individual is going to be investing different types of funds like pre-tax and Roth, there'd be different accounts at the exchange. And then of course you have to fund that account at the exchange with fiat, right? With US dollars. And so that funding would need to come from, say, a bank account opened up under the name and the EIN number of the solo 401k, for example, for Roth funds. So the individual might have a bank account for their solo 401k, which we help clients open up accounts every day at hundreds of different banks and brokerages, maybe make a Roth contribution to that solo 401k bank account, and then separately transfer the money from the Roth solo 401k account to the account at the cryptocurrency exchange to invest in cryptocurrency. How do I calculate maximum contributions based on 2023 tax return? Well, it depends on how the business is taxed, but if the business is taxed as an S or a C, the individual would use W-2 wages that they received for 2023 from their self-employed business that's taxed as an S or a C. Hopefully that helps. Yes, absolutely. And if you go to our support page, mysolo401k.net/support, it'll guide you through the process to be able to add the auto contribution feature to your plan and be eligible for the credit starting in 2024, of course, since it wasn't added here until 2024. Thank you so much for the good question. My son is 19 years old and he has money in his Fidelity Roth account. He got about $10,000 in 1099 last year. Can he open and contribute to the solo 401k? Well, he would need to have his own separate plan, right? If he really is getting the 1099 income, from some other activity. It sounds like he's got a Roth IRA, but if he is 18 or over and he does report earned self-employment income with no W-2 employees working for any business owned by him, or if he were married by a spouse, if any, then yes, he could set up a solo 401k and he'd be able to make contributions based on that 1099 income. Now, he's not going to be able to contribute more than the self-employment compensation, right? You can't save more than you earn. And for somebody who reports their income on Schedule C, because they're, say, like a 1099 contractor, you have to run a pre-calculation where you take line 31 of Schedule C, so that's the net income, less 1/2 of the self-employment tax. That pre-calculation gives you self-employment compensation, and then that is the number that's used to determine how much that can be contributed. Thank you for the good questions. I'm contributing employee contributions for my regular job, and I have my self-employed business. Employer, yes. So even though you might be maxing out contributions to the day job plan, an individual that is self-employed, that does report earned self-employment income with no employees working for them, could set up a solo 401k, and the employer contribution limit to the solo 401k, right? Let's say their business is taxed as an S, and they receive W-2 wages from their self-employed business taxed as an S. They're going to be able to contribute 25% of those W-2 wages to the solo 401k as an employer contribution. And that contribution limit is not reduced by contributions that are made to a 401k plan sponsored by an unrelated employer, like the day job plan. Hopefully that helps. And scenario number 4, 69,000 maxed out Roth version. Presumably you're leaving FICA and federal state withholding out of your, yes, because you don't have to reduce W-2 wages by self-employment tax like FICA and withholding. It's as simple as taking box 1 of the W-2 plus any pre-tax elected deferrals not in box 1. In this scenario, for example, you don't even the person didn't have any pre-tax elected deferrals, right? Because we're assuming they want to maximize contributions made to the Roth. So it would be, as long as they have at least 69,000 of in box 1, they would be eligible to contribute all of it as a Roth employee, as well as after-tax contribution to the solo 401k in this scenario number 4. Hopefully that helps. If you go to the YouTube channel, if you go to YouTube and just search for My Solo 401k Financial, we'll come right up, and then you can easily subscribe. Thank you so much. Oh, thank you so much for the good feedback. We appreciate it. We do appreciate you guys taking the time to join and ask the good questions. We certainly do have it on the docket. Thank you for raising that. I know they're regularly changing their procedure over there. Well, technically no, but it does depend on what the plan rules allow. So for us, we wouldn't, just based on experience, we know that it's quite difficult to open up accounts for minors for a solo 401k. So we wouldn't, as a business matter, open up a solo 401k for a minor, just because we know how difficult it is. Hopefully that makes sense. So if your self-employment income is an LLC, so you could still set up the solo 401k and make employer contributions. And if you subscribe, that's the next one of these on the schedule, is this same type of content, but geared towards a self-employed business is taxed as a sole prop or a single member LLC. But you have to run that pre-calculation, right? Line 31 is Schedule C, less 1/2 of the self-employment tax. And then of that number, the individual will be able to contribute 20% as an employer contribution. Like I said up above, it's not reduced by contributions made to the day job 401k plan. My business is set up as a single member LLC. If I elect to be taxed as an S-Corp, can my wife also make contributions based on her W-2 from the business? Yes, if it's W-2 wages from the business, right? Not W-2 wages from a job. Thank you so much. So yes, if your business is taxed as a single member LLC, you don't need to receive W-2 wages to justify contributions to the solo 401k. You have to have that earned self-employment income, though, reported on Schedule C, and then run that pre-calculation that I mentioned. If an S-Corp business owner wants to minimize his self-employment taxes and earned $65,000 as W-2 in 2023 and earned $500,000 in total, he can only do 25% of the $65,000 as an employer contribution and the remainder as after tax. That's correct, right? Because it's always based on that earned self-employment income, right? It goes back to the way I think about it is that 401k is for people who work, right, to save for retirement. And so a solo 401k is for a self-employed person, but you still have that notion that it's based on the earned income. And so in the case of an S corp, a self-employed business tax as an S corp, it's going to be those W-2 wages, right? Not the profit distribution that the individual receives as the owner of the S corp. Hopefully that makes sense. Thank you so much for the good participation. It looks like we come to the end of the questions. We do have a few more moments if there are any additional questions. We'll just continue to highlight that we have a wealth of resources on our website. Please like and subscribe to get notifications of all the upcoming sessions. Or you can go to the community. We have daily Zooms on there, mysolo401k.net/my community. It's always free to join. All are welcome. So we appreciate all the good participation and the opportunity to discuss these good topics. All right, well, that does look like it takes us to the end. So all the best, everyone. Thank you so much.